In a world where every step is calculated, every decision is data-driven, and every move is anticipated, there lurks an unseen storm, a tempest that no expert predicted, no algorithm detected. Are we prepared for the unexpected?
Dive deep with us as we unravel the truth on today's Stock Market Brief Show, everybody. Today's video is titled An Economic Crisis That Nobody Sees Coming, but I tell you what, people feel it. We got a lot of data, a lot of charts to go over on today's Stock Market Brief Show, ladies and gentlemen. We're going to get right into it. Oh boy, I can feel the comments coming already. I can see them. So bearish, this means it's really bullish, and this and that. Yesterday I made a video about the stock market bouncing, and it bounced, right? And I think we can still potentially bounce more. But oh my gosh, how many people said that the market wasn't going to bounce, and it did. It always does what you don't want it to do, right? So we're going to just present some data. Remember, this type of data that we're going to be sharing is macro data, right? It doesn't mean it responds to markets right away, which we'll go over. Now, I'm going to start off showing you this chart. Now, there's 3 different dates on this chart: 1985, 2008, and 2023. Now, these are showing the times where we had a sequence of 7 consecutive negative non-farm payroll report revisions. Now, in 2023, starting here in January, we've had 1 negative revision, 2, 3, 4, 5, 6, 7. Now, employment numbers are mostly the most lagging when it comes to the economy. Okay, especially when we go into recessions, they're the most lagging. But what I pulled up here was the other times dating back, I think, to 1979. You can check the BLS.gov. Any other time that we've seen 7 consecutive negative revisions. And the only times that I can pull was 2008 and 1985. Now, these dates should look somewhat familiar. 2008 being the main one. 1985 wasn't all too bad, but we did have the 1987 stock market crash that took place, and we also had the 1990s recession, but that's years after the fact. 2008 did as well, which we all know is the Great Financial Crisis. Now, there's not been, since 1979, 8 consecutive negative revisions, so we'll see if we're going to get a record here coming up on the next report. Okay, now I also wanted to look at, okay, well, what about 6 consecutive negative revisions? Well, we've had it a couple of times. In 2016, there was a lot of market volatility in 2016, but this date should look familiar to you too, 2002, right? We had 1, 2, 3, 4, 5, 6 negative report revisions there, and as we know, that was during the dot-com bust, and as this last report came, actually the market fell quite a bit more after that point. Now, I tell you what, we're getting a lot of reports out there about soft landings, right? People are talking about, that's like a key word that people have been saying, right? So we've been talking about the soft landing, right? We're a soft landing, all these soft landing signs. But interestingly enough, they did the same thing back in 2008, 2007 as well. They started talking about, yeah, there's some things that are going on, but, you know, I think we can get out of this with a soft landing. And what has the Fed been doing? The Fed is tightening, right? You can see the balance sheet right here. We're still declining, right? So the Fed is tightening. You can see M2 money supply year over year. It is negative, right? Coming off of some crazy levels, so that makes sense. But we are still negative, which we have not seen throughout history. If you look at the federal funds rate, what are they doing? Well, they're lifting rates, higher rates for longer. Why? Well, we're fighting inflation. The core inflation is still above 4%, and we get actually core inflation data on the 13th, which is Wednesday. Then we get PPI, and then we get also Michigan consumer sentiment next day. So they are fighting to get inflation down to 2%. This is a 25-year chart, so we're still high, and you could probably feel that at the pump, at the grocery stores, at restaurants. All your hard-earned dollars, you get less for them as prices have been increasing. All right, I mean, just take a look at the 30-year fixed mortgage rate. We're at levels that we haven't seen since, well, back there towards, even past that actually, back towards the dot-com bubble area, and we're back around, kind of around the great financial crisis levels there. It's no surprise that you see applications to buy a house plummeting, to levels that we haven't seen back till, 2013, 2014. The debt-to-income ratio for home buyers, you can see, has been blowing off higher than 2008. And then, if you take a look at this chart, this is quarterly transition rates for 30 to 60 day late mortgage accounts. So this is basically saying, hey, are we 90 plus days late or are we current? And what you'll notice here, as that transition is taking place, you can see current are actually going down while the 90-day rate are starting to move up. And what you'll notice here is that actually kind of the jaws closed in 2008 in the financial crisis, where you saw a big spike up in the 90-plus days late, and then you saw a big drop down in the current. As we're seeing this drop and this, you got to wonder, hey, if delinquencies are obviously going to continue here, this could be potentially bad. But as it stands right now, it's just interesting data point. Continuing on, take a look at loans and leases and bank credit. So we know that the Fed is tightening. Well, you can see now banks are doing the same thing. And every recession, what you'll notice here, recession is these gray shaded areas leading into the recessions. And within the recessions, just so happens that you'll see the year-over-year change decline. Okay, you saw it right here. And now we're starting to see it. Now, it doesn't mean that every time we decline, there was a recession. However, it's still important to note that when we see tightening here, it can lead to a recession. And every recession, you got to be at least on guard, has had the tightening there in credit cycle. Now, if we continue on, you can also look at something like quarterly change in deposits. We were showing this at the first quarter, this big, huge drop here, and the second quarter. Okay, that actually led to the SVB, right, Silicon Valley Bank blow up. And this is where they came in with the bank term funding program. And, call it just perfect timing or call it a form of quantitative easing. You can see the market responded quite well when this came into play. And now it's starting to kind of level out there. It doesn't have the same kind of rate of change to the upside. So what you'll see is the market is kind of just going sideways here too. If you take a look at the 10-year and 3-month yield curve, we're here right now. All right, when we were negative over here, that was the 2020 recession, the great financial crisis, the dot-com bust, and you also had the 1990 recession. I'm not showing you the 10-year and 2-year as of right now. I wanted to show you the 10-year and 3-month because this is considered a Fed staple, or, after they said that the 10-year or 2-year was no longer important, they said the 10-year, 3-month was, and we haven't really talked about that one since. Okay, but if I do pull up the 10-year, 2-year, what you'll notice here is we have the Fed rate underneath us, we have the 10-year, 2-year, and as this uninverts, this is far from uninverting right now. It's at around the same time that the Fed started reducing rates, right? It's when they started cutting, even right here, uninverted, they started dropping rates. Okay, we're holding rates here higher for longer is what the Fed says. And if that is the case, well, chances are, what are they going to do when it lowers? Well, they're probably going to be lowering rates if something were to actually break. And you can just see that right here. As it uninverts, boom, boom, and boom. What you'll notice here is actually the market responded poorly. The market responded poorly, and the market responded poorly. So you got to ask yourself, hey, what happens if we start uninverting and, well, they start dropping rates back down? What would cause them to do that? Potentially some sort of an event, right? Some sort of catalyst, some sort of something takes place in the markets that we need to be just on guard for. You can really see that here. If you take a look at the 10-year, 2-year yield curve, okay, this is the inversion. So everything below that blue line is inverted. And what you notice, if this uninverts, right, if it goes up, the market kind of goes down. So this has been going up, market's going down. On the flip side to that, what we noticed was if it goes deeper into inversion, the market actually rallied, right? So deeper into inversion, the market rallied. Deeper into inversion, the market rallied. Deeper into the inversion, the market rallied. So just be aware that, hey, if the yield curve, right, the 10-year starts moving up, which it has been, more so than the 2-year, it will uninvert. And that could put pressure on the overall markets. Right? There's a lot of people talking that we could very well be, in a brand new bull market, everything's perfect. However, you got to understand that this is this is a chart of the psychology of markets, right? Where you have this is basically right after the main sell-off coming out, where you get the takeoff, the first sell-off, the bear trap, you get enthusiasm, greed, delusion, new paradigm, and then you get this big sell-off that could be 2022, and you have that return to normal phase. And that's kind of where we are right now, the return to normal. Now, does this mean that it's going to crash down and we're going to go into here? Not necessarily, but I will tell you, I mean, things aren't looking all too hot when you look at the bigger picture from a macro standpoint. So we got to look not only at a macro data standpoint, but we also got to look at, zoom in a little bit even to just what it is like for the consumer, right? If you take a look at something like for the consumer, what you'll notice here is credit card debt, right? Boom, we're just cranking higher and higher with credit card debt. Meanwhile, the savings rate is going lower and lower. You can take a look here at interest on credit cards is at a new high right over here. It's over 21%. And you got to think like, okay, well, that could be hard to service debt. And you'd be right, and I'll show you. But not only that, look at the average monthly payment for a new car in the United States. It's at $733 a month. Okay, that to me is actually absurd, right? So the average monthly payment, an average is $733 a month. I mean, just look at the average income in the United States. You'll probably be shocked too as well. So you got higher, you got credit card debt that's going up. You got average monthly payment for these cars that are going up. Where's this money coming from? I don't know. Transition into delinquency. So you would think that people are going to start becoming delinquent on their payments. And, well, you would be right. Take a look at auto loans, green, credit cards, blue. What you're seeing here is big, rapid rates of change to the upside in recent year, right? So you have 2.2 Q1, 2.3 Q1, and so forth pushing forward. And what do we notice? If you just draw a line going back, this is going back to around, the credit cards is back to around 2011. And then if you go back even further, we're not too far off of where we saw the big spike there in 2008. Now, if you look at 90-day delinquencies, this is very serious delinquencies. What you'll notice here is we're coming back to around that 2020 level, but then prior to that also, this is kind of where we were before really exploding to the upside as well. If you take a look at third-party collections, this is kind of interesting where you have the percent of consumers, all right, that's the blue line, boom, 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 that are going into collections. That's actually dropping, but what you'll notice here is the average collection amount per person has shot up dramatically. So it seems to me like, hey, people that are in bad positions, it's getting worse, and people that are in good positions are still holding up. One thing that I did notice from this chart is obviously the student loan, right? The student loan debt is still flat. And what can amplify these problems? Well, what can amplify these problems is obviously if student loans came back into play. So you look at the 90-day delinquencies, there aren't any, right? There's this big drop-off. Why? Well, because they haven't had to make payments. But that changes coming October, right? This was a cool little tweet here. Student loan payments are set to resume in October for the first time since 2020. There is now a total of 45 million people in the U.S. with student loans and 1.6 trillion of student loans outstanding. The average monthly student loan payment is $200. This means 9 billion in consumer spending will be subtracted every month. So another large shift, obviously, in consumer spending would make sense. But what can amplify that even further? Well, the unemployment rate rising would change that. And what we've been seeing there with the revisions, we saw a little bit of an uptick in the unemployment rate on this last report. And you'll notice that going into 2008, you see these spikes. 2000, you got that spike. And 90, right, you got those spikes. And this is very similar, right? So if you look at 2000, if you look at 2008, and you look at where we are now, what I find so interesting is if you put this together, this was during the same time, right, where we were still inverted. Rates were high, right? We went to a rate hike tightening cycle, right? Boom, boom, boom. But then also we were looking at the consecutive negative non-farm payroll report revisions where we're now at 7. 2008 we're at 7. And then in 2002 we had 6. So it's not a good trend that's taking place, all right? You have so much different data and so many different aspects taking place right now that it's hard to believe that things can get better from where they currently are. And that brings me to what Jamie Dimon said today. It's a huge mistake to think the economy will boom with so many risks out there. And it makes sense. But that doesn't mean, people, that the market has to go down right this moment, right? So if we look at the seasonality, we know that we're in the month of September. A lot of bad things have happened in the month of September, which we pointed out in prior videos. It's typically towards the back half of the month. Last video that I made, we talked about a stock market bounce. Well, we're going into the 7th trading day of the month, right? It still looks like, from a seasonality perspective, pre-election year, we get some upside momentum. We talked about the bullish divergences that were forming and potentially playing up. We talked about summation index. It's still on a bullish tilt despite being under zero, but the parabolic star is still above it. It looks like it's going to flip here soon. And then the NYSE summation index still good there too as well, but also looks like it's going to flip. We talked about the DEX yesterday. I think I said accidentally that it was a bullish bias. I meant bearish, but it happened to be bullish. Now we have a green DEX, which is, the daily sum of deltas across the options, entire market options flow. So there's more of a bullish tilt going into tomorrow. Now, if we take a look at the SPY on the 15-minute time frame, what did we do today? Well, the daily expected move was right around this blue line level. We got above it. We came back in it, and then it started holding that level. So we did close above it. That's good. We're above the month-to-date anchored VWAP. We got that bounce. We're above the 5-day moving average. It's still declining. We're above the week-to-date, which was started today, and we're above the quarter-to-date anchored VWAP, which is flat. So as long as we hold up in these levels, this is a good start to a potential bounce. The longer we stay, the 5-day moving average will have to start flattening out and then start turning up. So yeah, even if we get more chop, like so, or if we come shoot up here, like a stronger move, right? It looks like a little cup with handle on this smaller time frame. We come up here, hit this upper daily or even this upper weekly, and if it starts backing off, understand the 5-day, as time progresses, it's going to start curling itself back up, and it's going to offer up, as long as that trend continues, some good opportunities in the short term. If you just take a look at the weekly time frame, we're above an inclining 5-period weekly EMA. You can see it tagged down there, but it held as a level of support, and we're just contracting, right? So you can just see here, we're in a period of contraction. You have one big volatility week, inside week, and now we're currently inside with still quite a bit more time to go. You take a look at the dollar backed off today, and the dollar backed off. The S&P 500 was up, but it wasn't only that benefited from a falling dollar. Take a look at copper. It was up 2.44%. Gold was up slightly there on the day too, up 0.23%. Silver was up 0.9%. And the miners, you can see they follow very closely. This was one of the trade ideas that we gave back a few videos ago. I will note that TNX, the 10-year yield, was up on the day. However, that didn't really affect the markets all too much. If you take a look at the heat map, Tesla was up a whopping 10%, but maybe that's why we saw things like Google and Apple, and, even Nvidia was down, but Apple and Google, they're pretty much flat on the day, up 0.5% to almost 1%. Same with Facebook. So maybe the 10-year yield, it hurts the growth stocks, but the big move in Tesla really did help out the overall market. But it just couldn't get the other stocks quite moving. If I quickly take a look at the Sailor to Shift tool, it is still on a sell signal as it stands. We got some weakness in the price of Bitcoin. You can see it's kind of breaking down here. Pretty big red candle. So I just be careful there, but I'm watching to see if this flips up here in the near term. But as it stands, we're still on that sell signal as of now. That's all I got for you on today's episode, everybody. Hope it helps out. I'll see you on the next.